Okay, well, let's go and let's start chapter 9. We have 9, 10, 11, 12, and 13. So we've got about 4 more chapters to go until we're entirely done with the course. So let's get started. We've got more journals to learn. So I want to show you like a little cheat sheet for just a second. All right. You guys are used to the general ledger and the general journal. And now through chapter 8 and 7, you've seen an accounts payable and an accounts receivable ledger as well. We've seen a sales journal so far. We've seen the purchases journal. What we haven't worked with right here is the cash receipts journal for accounts receivable and the cash payments journal for accounts payable. So this whole chapter is about using cash receipts journal and cash payments journal, excuse me. Also, it's about using the petty cash fund, and it's about reconciling bank statements. So that's kind of like a summary. This is posted, this little flow chart I put under class notes in Blackboard, so it's there to look at. So you can pull it up anytime. All right, so in this one, let's just jump to things that we're going to do. First thing we're supposed to learn is putting a cash receipt into a cash receipt journal. So let's take a look at the journal itself. It's kind of like strange because we've got accounts receivable, because cash receipts, is for paying for accounts receivables. We have our sales credit, the amount of the sale. Then we have our tax column, how much of that credit goes into taxes. We have this new thing here called other account credit, which you'll see because we're going to do some of that stuff too. And then you'll see the cash debit here. And it's a cash debit because it's a cash receipt journal, and it'll be cash credit when we get to the cash payment journal. Okay, so like I listed before, at the end of the month, you're going to have to total all these columns and post them to the general ledger. So that's the purpose of using these journals, is just to take the totals and be able to post them without having to post them all individually. So let's look at a cash sale here. For example, Max Out Sporting Goods received cash, a cash sale. So notice you got the total amount of the sale and the sales credit. You have the tax and the tax payable for the entire purchase. And then you have the purchases over here, $4,860. Other accounts credit. Let's go ahead and look at cash short and over. What this means is sometimes the cash account has mistakes. And we have an account now called cash short and over. So when there's an accounting error in the cash account, what you have this new account to account for shortages and for overages. So if your cash comes up short, it goes on the debit side. And if your cash is over, it goes on the credit side. So short on this side, over on this side, which makes it nice because it's already like the word is above the side that it belongs on, which is awesome. So what does that mean? That means when cash comes up short and the shorted amount is put over here on this side, it means that it will be recorded as an expense because expenses are debits, and this is a cash shortage, so that's an expense. If we have too much cash and we have a cash over on the credit side, we count that as revenue. It's extra cash. It's then counted as revenue. So that's what this account is all about. So let's take a look at how that's recorded. On January 15th, there's a shortage of $18 in the cash register. Total cash should have been $5,184, but only $5,166 was in the cash drawer at the end of the day. So either somebody's accounting is off, or they sold $18, or who knows. But you still need to account for it. So you'll see on the 15th here, we have cash sales, $18. What we do is that's when the other accounts credit comes into play here. This account name you have to write down. So we're going to write down that the cash short and over account is now going to have $18 in it. Because why? Because we need our credits to equal our debits. Make sure that they do when it's done. Okay, so let's look at what happens next. Ann paid $702 on account. This is she paid in cash. So her accounts receivable goes down. That gets a credit, accounts receivable credit. And the cash debit goes up, 702. In particular, this exercise doesn't deal with cash discounts on sales, but some companies do a sales discount. We're not going to deal with it here. But what they do want you to know is that you don't always collect on accounts receivable on time. So this is what's going to happen. They're now going to introduce to you a new account called notes receivable. So we have accounts receivable now and notes receivable. And accounts receivable is for those accounts that they expect to get payment within 30 days. Sometimes 60, sometimes 90, but mostly 30. Now, let's say you're a customer and you can't pay within that 90 days. Then they put you in a collection. They make you do a promissory note, a notes receivable, saying that you're going to pay in so many days at a certain interest rate. They're not going to let you do it for free. In this case, they're going to charge 9% interest. So what does that look like? See what this looks like now in the general journal? It's notes receivable because now we're going to pay at a later date, but we still got to take it out of accounts receivable, which is normally a debit. So we're going to put it in the credit to take it out of accounts receivable, and then we're going to put it in notes receivable. Then they're going to make you also learn to figure out the interest on the note. So if you owe $800 and you're charged at 9% a year, and you're going to pay that note in 6 months, then they figured it all out for you here. This 9% a year divided by 2 is 4.5% for the 6 months, leaving you at $36 interest. So how is the interest then recorded in the books? Let's take a look. In the cash receipts journal over here, you're going to have your note collection at the end of the month. Will go into notes receivable, and then interest income. That way you have this whole transaction, all the debits equals the credit, 836 here and 836 there. Now let's look at the cash receipts posting to the subsidiary ledger and the general ledger. Okay. This is your cash receipts journal again. Notice that before you post, well, it says to make sure all the debits and credits are equal here, that all your accounts receivable, that it's equal to the sales tax plus the sales, the sales credit is equal to the sales tax plus the accounts receivable. It's really, really hard to read here. But you know what? I don't think their exercises even I didn't make you do that in any of our problems today. Our problems today are going to be much simpler. And the reason they're going to be simpler and not to fret so much is because in the real world, again, the computer is going to do all this posting to the ledger for you. It's going to put everything in the cash receipts journal for you. It's going to put everything in the accounts receivable journal for you. So I don't like to focus too much on the journal entries. I want to focus more on how they're entered and why they're debits, why they're credits, things like that are way more important. But also just check it out here. We've got a cash total, cash debit over here. And basically you're just going to post that total to the general ledger. Let's take a look at that. So we've got a subsidiary ledger here. That means the individual ledgers of every person. Notice we're going to put a CR for a cash receipt. S1 is for sales journal. Okay, before I get to the cash payments journal, let me just take a look one more time back here. You're going to put what you posted to page 1. We're good with that. And we're going to put a check mark here to let you know that we've already posted Ann's $702 cash receipt. Now we're going to look at the cash payments journal. And then we're going to go look at how it all goes into the big general ledger. Okay, this is a cash payments journal, so this is cash credit because that's cash leaving the company. We have CP1 here, meaning cash payment journal, page 1. And now we're going to take a look at what exactly gets posted to the general ledger. So let's take a look at this. We've got accounts payable. We got the total, $13,750. That's the amount that's going to actually go under accounts payable in the general ledger. So notice how we're just using the total. We're total amounts. That's it. The little amounts go into individual subsidiary ledgers, and the big amounts, the big totals, goes into the big general ledger. And I'm pretty sure I don't have you doing any posting for homework. So let's take a look at what a petty cash fund is. There's 2 more concepts in this area that they want us to look at. So let's go through both really quickly. We need to demonstrate what a petty cash fund is. So that's like a little cash fund you have on the side to pay for little expenses that you don't want to write a check for, like $16 for stamps or $8 for office pizza or something like that. But you do need to fill out little forms as to what everything was for. So this would be a petty cash voucher. If somebody wrote out that they went out and bought $16.25 worth of supplies, and they took the $16.25 out of cash to pick up something for the company. They also, it's done monthly, so at the end of the month, they want you to learn how to replenish the fund and put the money back into the account that everybody took out of the petty cash fund. Okay. It's only used, once again, for small payments that cannot be conveniently made by a check. Usually the fund is limited to a certain amount, like $200 a month or something like that. Usually one person controls the petty cash fund. And usually there's a voucher for each payment that goes out, even if it's just a handwritten note. Like I took $8 out to go to the post office today to buy stamps and write it down, the date and the amount. That's all that's really required. Okay, so let's go over, we're not going to go through the internal and external controls of cash payments. We're going to look, I'm going to show you how to do the petty cash fund in our homework. They didn't give us an example here, so we'll do it in our homework. We also have a lot of this in the homework. This is balancing the checkbook. So they have what's called the bank balance and compared to the book balance. The bank balance is what the bank statement says you have in your checking account, and the book balance is what the accounting says you have in your checking account. And they usually never match because you have to take into account outstanding checks, outstanding deposits, maybe return checks, maybe a service fee, maybe a bounce check fee, anything that happens in the banking world. Okay, so they want to show you a picture of a check stub, which most of us have seen before. But here's what they want you to really look at, because this is where you look at it in your homework. What the bank balance was at the beginning of the month, and then what it is at the end of the month, and then it's your job to figure out everything that happened in between. All the checks that cleared, all the checks that didn't clear, subtracting the total amount of the current check, and so forth. So as I was saying, they'll make you look at one of these check stubs. You'll take the balance, you'll take the outstanding checks, and you'll just make sure that everything works. Again, these PowerPoints are sucky, and we will actually learn it when we do it. They want you to be aware of the different types of endorsements that are out there. You can say pay to the order of on the back of a check and write out who it's paid to. You cannot write anything on the back of the check, or you can make a restrictive endorsement saying that it's for deposit only and not for taking cash out. This is how you would transfer a check to someone else. Okay, as far as reconciling, this is the steps. These steps, it doesn't work very well unless you follow their steps exactly. I also have a handout on it. Let me see, do I have the handout up here? Steps. Yeah, it's not up right now. Steps to reconcile the banking statements. Do it in the order that they want you to do, which I'll pull up. I also have the handout in the order they want you to do it in online in our notes section in Blackboard where it says class handouts. Do it in the order that it says on the class handout or on this PowerPoint, the same thing. In other words, they're telling you to always balance the book before balancing the company. These are reasons that things could not balance. So the first part is to, like I said, balance the bank reconciliation statement first, then balance the book balance. So do them in this order, exactly like it says on the slide. You're going to take the bank statement balance, add on the deposit, subtract the outstanding checks, or plus or minus any bank years, and you'll have this amount. Then do the books of the company, the book balance plus the deposits, deductions, or any years, and make sure that they both balance. And I think we've got like maybe 3 exercises on this, so we're really going to have that one down. But this just breaks it down step by step, remembering to do the bank side first before the book side. They want you to do the bank side first. Then you're going to reconcile the second section, which is going to be the book side. And this is kind of what it looks like when it's done. You'll have the bank balance written down, all the additions, like all the deposits, then all the checks that went out, all the subtractions, and you'll have your adjusted bank balance. Then you'll add in on the bottom the books to the company and their deductions and their outstanding fees and their adjusted book balance. And notice they're the same, so it's all balancing. But also notice one more thing. I don't know how much you can see that. Let's see if I can get my screen bigger. Okay, that's better. I probably should have done that first. Notice that there's a bank service charge. That means they pulled up the statement, realized they're $25 off, and then realized there was a bank service fee. You can't just throw that in there to make it balance. You're going to have to put that bank service charge now into the general journal. And you're going to have to say something like bank service expense and then cash credit. So whenever this stuff kind of is floating around there, you have to make a journal entry to fix it. Okay. So again, like record any, just that's exactly what I was just saying. Okay. So in this case, that bank service fee is here. They recorded it for you. Accounts receivable, bank service fee expense. You just have to make an expense account for that and then take it out of cash to record a non-sufficient check and the service charge for the bounce check. So this was a check that came back and bounced, and they had to take care of it, put it back into accounts receivable, take the cash back out, make a credit because they didn't get it, it was a bad check, and then write that you have a bank fee expense. Okay, and the rest of this is just it's just the end, but other banks like to do. Excuse my phone there. Okay, let's jump into the homework.